Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, June 25th, just after the close. The Moose is in the house today. We'll get some thoughts. John wants to share a few fixed income bond market thoughts with recent Fed meetings. First, on the equity side, again, good bid throughout the week. The big theme this year has been just rotation amongst sectors. When we get a pullback in any sector or two, there's demand to meet it. We spoke about the weakness in banks, the weakness in energy last week. Boom, this week demand back in. We got some help, of course, out of the news that the banks are going to be able to raise dividends, increase buybacks, due to their strength of their capital position. That should continue through the near future in terms of stock strength. But in terms of real demand on beaten down values, very impressive. You know, look no further than one of our holdings in the U.S. equity portfolio, solar energy. Recall solar energy doubled last year. We took some off the table of TAN around 120, traded all the way down as low as $72. We added a bit back. Has a nice 20% run over the last 3 weeks. Great rotation, great opportunity if you have a little cash available and have targets for what you like in terms of individual names or sectors. How about bonds, John? What do you got?
I'll tell you, this week, Matt, saw a little bit of a change from last week. So more reversion of the mean and gyration. So you had the 10-year Treasury at a 152 and the 30-year at around a 215, basically up 8 and 13 ticks respectively. Muni yields very well behaved. I mean, they're at about 60 and 70% ratios. So think about a 119 and a 152.
When you say ratios, what do you mean there?
A ratio, a municipal yield compared to a Treasury yield. We know they were very cheap last year.
Right.
We know they've gotten very rich this year for most of this year because people think a tax increase is coming and there's been big demand across the curve. So
last year we were getting paid more in coupon out of tax-free bonds versus taxable, apple to apple.
Almost apple to apple. And now the demand's flipped over on the other side. And as we've spoken, supply has been muted for most of this year because municipalities have been in very good shape for the most part. And some of the municipalities didn't want to issue bonds, the more pandemically affected ones. That's changing, we think, in the second half, and you'll see a little more issuance. One thing that I did want to talk about today, though, was that last week we saw the Fed, for the first time, talk about talking, as they say, about removing stimulus down the road, perhaps raising short-term interest rates down the road. I think this is a game changer in the sense that it takes away some of the certitude we've been living with over the last year. And now people have to think about that there is a date when the Fed is going to start to tack away from what they've been doing. So what we think this means is a change in the way the bond market reacts, and maybe that gradually you move to higher rates, that you move a little bit lower, but maybe then back a little higher. So the trend over time should be somewhat higher. I think it's very important to look at a week like this week where you have the Fed's preferred measure of inflation, the personal consumption expenditure, jumped up. I think they were expecting 0.4, they got 0.5. You look at things like initial jobless claims, a little higher than expected. So there's cross currents out there. But what's really important to remember is that over a longer term basis, interest rates do not change necessarily right with the rate of inflation. There is a lag period. And we put a graph up from 50 years ago just to show some really extremes, because those are the days of very high interest rates and very high inflation. And shows you the difference between the consumer price index on a year-over-year basis going forward and the 10-year Treasury bond. And I put this up there to show you that it doesn't always go hand in hand that interest rates are going up at the same pace inflation is. And there's an expectation, just like we talk about today with people talking about inflation being transitory. We'll see on that. Go back then and inflation really shot up in the early 70s and came right back down. That was the Gulf War. Interest rates only moved up a little. But then as you moved into the later 70s, they shot up again. Iran hostage situation, other inflation issues. And of course, what happened? Paul Volcker comes in as head of the Fed and raises short-term interest rates. They cause long-term interest rates to go up. And you see interest rates go well above inflation, and they stay there. And look at the end part of that graph. Not only inflation starts to come down, but interest rates don't. Interest rates stay high because they want to be proven that inflation's coming down. So expectations both ways plays a large part. Because we know a lot of people out there said, why isn't interest rates higher? Aren't they higher? I know, I'm one of them that asked that question. But there is a lag time to this. So as we go through the rest of the summer, again, we look at the month-over-month numbers and see how things play out.
Good points. And in terms of interest rates and how they may react to inflation, I don't think you would be surprised, John, if, let's say on the 10-year, we traded in a 150 to 250 range over the next 6, 9, 12 months.
Absolutely.
You know, there's so many shrill conversations about rates going higher, rates have to go higher, rates have to go higher. But there's so many other effects to interest rates.
That's right.
You know, the technology that drives down cost, that drives down pieces that go into an inflationary scenario.
That's right. And we see inflation on some items and
Yeah.
reduced prices on others. And it was only 2.5 years ago we saw the 10-year bond at 3%.
Right.
So, you know, your point's well taken, Matt. It's you've gone from that level to way too low during COVID because of all the situations going on. And now you're kind of in a middle ground as you head into an economy that's coming out of hibernation. And it's very important to watch not only the turnover of money, as we've talked about, but really the pace of economic activity.
Yeah. Thank you, John. Great points. Everybody have a great weekend. We'll see you again next week. Now, that's going to be the end of the first half. I have some very nice analytics and charts to share with you next week. So make sure you tune in, and we'll cover some of the historic moves in the first half versus the second half when we see double-digit gains. Very interesting stuff. Thank you.